Hey guys, Tom here and welcome back to the channel. Not the usual setting for today's video, and I actually haven't filmed a video for over a month, so it feels kind of weird to be back in front of a camera. Basically, I'm enjoying kind of an extended holiday at the moment, catching some fish and catching some rays of sun and just relaxing. Doing a bit of reading though, still got poor Charlie's Almanac behind me here. But the channel recently ticked over 20,000 subscribers, which is incredible, so I thought I had better put some sort of a video together. So I put up a community post gathering all your questions just yesterday, and I'm going to answer those questions in today's video. So firstly, thank you again for 20,000 subscribers. When I first started the channel with a random like walking through the park explaining rule of 72 video just on my iPhone, I really didn't think it would go this far, but it has, and it's been great, and yeah, thank everyone for all the support. So with all that said, let's get straight into the questions, and I do hope you enjoy the video. So the first question we have here is from Lil Tunafish. Thanks again, Tom. Got a newbie question that's probably really obvious, but would like to double check. Regarding the compounding return from shares, where is the compounding effect if I simply buy shares of a company only once, and that company never pays dividends / buyback shares? Let's say I buy shares of a company when the market cap is at $10 and it rises to $100 after a few years. I've simply 10x my initial investment. Isn't this right? This changes dramatically, of course, if the company also pays a dividend and I keep investing regularly. Thank you in advance if you manage to get to my question. Yeah, thanks for your question. So this is probably like a common mistake or misconception, or something that people maybe don't necessarily understand initially when they first start investing. So often people hear that you know, the stock market is a place to compound your money, so kind of grows like a snowball over time, and people often think that you have to get paid a dividend and kind of reinvest your dividends for that to happen, which is certainly a way of having your money compound. You can maybe put $1,000 into a business and it pays you a certain amount in dividends each year. You use those dividends to buy more shares in the business. You get a slightly larger dividend next year and it kind of just snowballs. That's certainly one way that stock market investments can compound. The other way that it happens though, in this case where a company doesn't pay a dividend or doesn't buy back shares, doesn't return capital to the shareholders, is really through growth in the business. So a really classic example of this is something like a Berkshire Hathaway. Now Berkshire Hathaway, Warren Buffett's holding company, is a business that's really never paid a dividend. They keep all of the capital, all of the profits that they make from their businesses within Berkshire Hathaway, and basically they're able to compound their company by reinvesting those profits for growth. So for example, Berkshire Hathaway makes a certain amount of money each year. Warren Buffett then allocates that to buying new businesses or investing in new stocks. Those new businesses and new stocks produce more profit again, and every single year he's able to sort of reallocate more and more money into more and more businesses, and that's a way that these companies can compound and snowball. So there's many companies that do that. Even if you buy into something like an index fund, which is, you know, going to give you broad diversification over a bunch of different companies, within that group of companies there's going to be some dividends paid out, but even the companies that pay dividends are probably going to retain some of their profits in order to reinvest in the company and grow the business. So that's kind of how the compounding effect happens in the stock market. Next question is from Vineeths. Is Beyond Meat a potential multi-bagger? Yeah, I guess all companies really are potential multi-baggers. It just kind of depends what happens. Beyond Meat is a company that I've actually kind of been keeping an eye on. I work in the agricultural sector as sort of my day job, so yeah, potentially it's kind of a threat to, you know, your New Zealand sheep and beef farmers and that sort of thing. So certainly one to keep an eye on. With a lot of companies, early stage companies, and Beyond Meat kind of falls into this category, it's really, really hard to predict the future, and Beyond Meat even more so because it's in kind of a new industry as well with, you know, synthetic proteins. So potentially one that yeah, is really hard to predict the future, and anytime that I can't have a good gauge on what the future is likely to be, 99% of the time it's not investable for me. I need to be able to buy something where I know that the price I'm paying is lower than the value of the business, and we figure out the value of the business by looking at the future cash flows we expect that company to generate. So Beyond Meat may do really well, it may do really poorly. I just don't know, and I don't generally like to play that game. So that's kind of my thoughts on that one. Brave Finance asks, I've clocked many lifting references in your videos. How much you bench? Yeah, I think I've actually answered this in a couple of Q&As now. I competed in powerlifting for probably 4 years or so. Doing a little bit of kind of strongman training and stuff at the moment, but honestly probably not taking it as seriously as I did in the past. But to answer your question, my best competition bench press was 157.5 kilograms, and that was done in the under 105 kilo body weight, like weight class. So that's that one. Jesse from Opportunity Cost Investing, what's your favorite video to make so far and why? Yeah, I was having a bit of a think about this one kind of before I actually turned the camera on to film this video. And I think probably my favorite videos I've ever put together would probably be some of the ones in the Monish Movember series, going through Monish Prabrai's best investments and Monish Prabrai's worst investments. There was a lot of work that goes into making those types of videos and trying to get together like the story of the investment, the initial thesis, what went wrong, what went right, and all that sort of stuff. So really enjoyed putting those together. Probably the other video that comes to mind is when I analyzed Charlie Munger's Tenneco investment from the early 2000s. Again, it's kind of one of these old school like investment stories, and I really like those success stories or the failure stories and kind of learning from great investors. So those are a couple that I've really enjoyed putting together. There's other videos on the channel that have got a bunch more views, but those kind of analysis ones are the ones that I can really sink my teeth into, and I enjoy kind of that process. So thanks for your question. Next question is from Garrett Dunsty. Apologies if I'm butchering your name again here. How much NOI do you think SRG will have in the future, and what are some other methods you have used to value the company? Yeah, so if you're not familiar, NOI stands for Net Operating Income, and SRG is Sharesight Growth Properties. Now, I did a live stream with Brad Kellner on Sharesight Growth Properties, and we answer that question directly in that live stream, so definitely go and check that one out if you haven't seen it already. But to answer your question, there's a couple of ways that we can look at valuing something like Sharesight Growth Properties. So Sharesight is a real estate investment trust, a REIT, but they're kind of unique in the fact that they're currently redeveloping a whole bunch of properties, and they currently have really negative cash flows. So it's probably not like your typical value investment where you just run a DCF on it and come up with an intrinsic value and have some sort of growth rate built in and all that kind of stuff. It's probably a little bit more complicated than that, but not super complicated to tell you the truth. So there's sort of two ways that Brad and I looked at valuing Sharesight, and Brad did most of the work on sort of one of the methods I'm going to talk about here, which is the liquidation value. So basically, you can either look at Sharesight by going through and valuing all of the individual properties, which is what Brad did in that video. You can look that theoretically, if you were going to sell all of the properties today, pay off all the debts and so on, how much cash would be left over, and then you can kind of figure out a liquidation value that way. The other way to do it is to use NOIs, like you mentioned, and figure out, based off how much income Sharesight can potentially produce in the future, what do we think that's worth? So we used, I think, around a 6% cap rate for most of the analysis in that particular video, and most of the analysis I've done personally on Sharesight. And yeah, there's a couple of different numbers floating around out there. So if you go back to, I think it was 2015, 2016, when Monish Prabrai first invested in Sharesight Growth Properties, he was talking, about sort of $1 billion in net operating income. I've probably got slightly lower expectations than that, but even if you land in this sort of $500 million to $1 billion in NOIs, and admittedly that's a very wide range, the market cap today of Sharesight is like maybe $800 million. So whichever way you slice it, if you think Sharesight can go through this sort of redevelopment phase and come out the other side without too much debt and producing, these strong cash flows, then it looks really cheap. And that's not a stock tip or anything, but that's kind of the way that we look at it. So I'm working off anywhere from 500 million to $1 billion, which again is a wide range, but the market cap at the moment is like $800 million, I think. So there's a fair bit of breathing room in there. It's one of these businesses where there's a lot of potential outcomes, but the purchase price potentially has a lot of downside protection. So again, not a stock tip, but that's kind of the way that I'm thinking through that. So next one, I don't think is a question, but Investing with Cam says, amazing, congrats Tom, here's me over the moon at 250 subscribers. Yeah, I mean, I was exactly the same, to tell you the truth. I think it took me, and I've done a video on this, I think I did a video when I was at like 3,000 subscribers, that it took me about 6 months to get to 100, and I think about 12 months to get to 1,000, and it is like a snowball. It's one of these compounding things. So if you're at 250, in terms of the time to get to 1,000 subscribers and monetization and all that kind of stuff, you're probably actually well over halfway, I would say, because it's sort of like an exponential growth rate curve, or that was kind of my experience at least. So keep ticking away at it, but I appreciate the kind words there, Cam. Next question is from SC358. What is your portfolio framework? Do you have a moving hurdle for allocation of capital versus cash? Do you make exceptions during widespread euphoria or pessimism? How do you go about managing the portfolio, position sizing, number of positions, trimming, etc.? And what type of investments will you make? Any other types of things you're willing to buy with some percentage of the portfolio or asymmetric smaller bets? How's your style changed since you started? Yeah, okay, so there's a fair bit in that question, but I'll see how much I can get through here. So in terms of the main core part of that question, in terms of how I set up a portfolio, I do actually have a video on this as well, and I think it's called something like Monish Prabrai cash policy or Monish Prabrai cash management strategy or something like that. I'll put a screenshot up here somewhere. And basically Monish Prabrai goes through sort of his hurdle rates of when he will take some cash and put it into investment. I mean, if you look at it at a high level, when you earn money, you've got that sitting in cash, and you have to get some sort of reasonable return for you to justify putting some cash into an investment. So he sort of puts, a percentage of that cash to work if he thinks those stocks are sort of a double in 3 to 5 years. He puts more of that cash to work if it's a triple in 3 to 5 years, and these are sort of his interpretations of the different stocks that he's looking at. And there's kind of different hurdle rates. So I've sort of basically copied that framework. Typically in terms of bet sizing or position sizing, whatever you want to call it, I've probably changed my philosophy slightly there. I used to probably have bigger positions, like 20-30% investments, which I'll probably still go there every now and then if I really do have a lot of confidence and there's basically zero downside in my mind of certain positions. But that one can change a lot. I mean, ideally, I'd like to be highly diversified in a bunch of super attractive opportunities, because then you can't have, one particular investment, destroy your portfolio or anything like that. But that's just not really the way it works in practice. We might have really high expensive markets where I can't find much. And in that case, I'll tend to be more concentrated into a smaller number of investments. If we were to go back to like a 2008 or a 2001 or something like that, where the market's just getting crushed and there's a bunch of cheap stocks out there, then I might tend to be more diversified because there's more kind of opportunities available. So that's kind of the way I think about it. In terms of the asymmetric bet thing, probably Sharesight again is actually a good example of that. That's a relatively small position in my portfolio actually, because it has again like a wide range of potential outcomes, but I think there is asymmetry. So I think there's far more potential upside than there is downside, but again, it's one that you've got to kind of size appropriately. And the way that I sort of think about that is the less potential downside there is in my mind, that can then be sort of a larger percentage of the portfolio. I think a lot of people kind of think about that in reverse, where they think, the stocks that can potentially go up the most can be the biggest chunk of the portfolio, and they end up with really speculative portfolios as a whole. But I sort of think about it as downside protection. I think if you look at the performance record of a lot of really good investors, most of them didn't become phenomenal investors by having like 1,000% return years or anything like that. A lot of them had really good track records by consistently chipping away and not really having any years where they went down like 80% or anything like that, because they had their portfolio blow up. So don't lose money is rule number 1 from Warren Buffett. So I'm trying to sort of stick to that with how I set up a portfolio. So long answer to your question, but I hope I got through all the main points in there. Next question is from Investing with Frank. Thoughts on diversification versus concentration? How many positions do you ideally want to hold? Personally, to outperform, I think a concentrated portfolio is almost a requirement. Yeah, I agree with that second part. I mean, if you just clone the market and have a hugely diversified portfolio, you're pretty much guaranteed to get, market returns. You're probably not going to do worse than the market. You're probably not going to do better than the market, but you have to do something different from just investing in the whole market to do well. So I probably touched on my thoughts on concentration versus diversification in the previous question. Really just depends on the opportunity set. At the moment, I'm more concentrated because I'm not finding as many things. But I do tend to probably be more concentrated than others. I've got the smallest allocation I've got is probably like 6 or 7%, maybe slightly less than that, 6 or 7%. And the biggest position I've got is probably like 25% of the portfolio. It wasn't quite that much at sort of cost. It's gone up a little bit, but that's probably the range that I'll kind of tend to float within. So Investment Frank has another question. Thoughts on the roll-up strategy? Typically, it's either a huge bagger or a complete bust. I personally like roll-up / tuck-in acquisitions, assuming it's in a fragmented market with a great capital allocator. Yeah, it sounds like you know a lot more than me about roll-ups, to be perfectly honest. I've read a little bit from Pabrai when he was talking about, I think it was the funeral homes getting acquired, and some of the things that went right initially and wrong towards the end there with that strategy, but I really don't know too much about it, to tell you the truth, Frank, so not sure how much I can add on that one. Khalid Weber, congrats on 20k, brother. Do you think we need a valuation method for the markets today, with more companies having assets that aren't tangible? Using things like price to book seems slightly antiquated. Yeah, thanks for the kind words again, and I agree. So really depends on the company how you value it. So I tend to be more of like a discounted cash flow style investor for most of the companies that I'm looking at, and that doesn't pay much attention to book value or asset value or anything like that. In most cases, you're just purely looking at the cash flows that a business can spit out, and if it does that with no assets at all, that's fine, and it can have a huge price to book, but the price to intrinsic value is really what matters. So I agree. I think a discounted cash flow probably ticks that box for you, but again, there's going to be some businesses, Sharesight, again, I keep mentioning it in this video, but that's a good example of something that has a lot of assets but not a lot of cash flows, at least right now. So that's something where you might have to think slightly differently. Faster growing businesses that aren't yet profitable, which again I don't intend to get into too much, if at all, but you might need to again think slightly differently there and try and figure out where's this company going to be in 3, 5, 7, 10 years, and try work backwards from there, because they might not have much profits, if any, at the moment. So that's how I sort of think about it. Investing with Frank has another question, but I think I'm going to be able to get through all the questions today, so I'll let you off this time, Frank. The more I learn about investing, the longer I want to hold my positions. I used to love 50-cent dollars, net nets, and even special situations. Now I'm looking for high quality compounders on a discount, hoping to never sell. What's your typical holding period and your philosophy behind it? Yeah, I think it sounds like you've probably been reading or listening to a lot of the later Monish Pabrai stuff, because he's kind of gone through this transition recently as well. I think personally, again, it just depends on the opportunity set. Like if I could have a portfolio of really high quality businesses that you just own forever, I'd probably do it. It's just that right now, a lot of those high quality compounder businesses are really, really expensive. I did a video a few months back, I think I called it like .com bubble 2.0 or something like that, where I went through a study from a value investing firm called AQR, and they basically looked at the spread of valuations in the market, how cheap are the cheaper stocks versus how expensive are the most expensive stocks, and that range is basically as wide as it's ever been. I think it got about that wide in 99, 2000, around the .com bubble, and it's even wider at the moment. So I think although it would be great to just, as Charlie Munger would say, buy a few businesses and sit on your ass for 20 years, I think it's hard to do at the moment. So in the current environment, it's probably easier to find 50-cent dollars, and that's kind of still where I'm hunting at the moment. But there's downsides to that. You need to, once they appreciate to 90 cents on the dollar, or, the full dollar and you sell, you have to find somewhere new to put the money and all that kind of stuff. So there's pros and cons to both. I think it just depends on the environment you're in. And holding period and philosophy behind it. So again, it probably just relates to what type of investment it is. So I've got a few things in my portfolio at the moment that are kind of, or at least were purchased as 50-cent dollars. So when they get to $1, I'll likely sell them and do something else with the cash, or I may even just leave it in cash if I can't find anything. That's kind of my philosophy there. But if it's a long-term compounder type business, it's likely to stay in there for a very, very long time unless it gets like incredibly expensive. So those are my thoughts there. And Investor Frank says, congrats on the 20k, well deserved. Sorry for 3 questions, take your pick. Well, I picked them all, so there you go. And thank you, Frank. Jack also says, subscribers continue to compound. Thanks, Jack. Karan says, congratulations, Tom, well deserved. What is your best investment so far? Doesn't have to be related to stocks or money even, could be investment of time or effort. Yeah, so I guess in terms of actual financial investments, I've had stocks that have doubled and that sort of stuff, but I really am yet to have like a big 5, 10, 20x or anything like that. Hopefully I've got a few of those sitting in the portfolio at the moment, kind of ready to go over the next few years, but I'm really yet to have any spectacular returning type stock. So I'll go back to the more kind of cheesy answer probably, which was I guess investing and trying to put as much knowledge into my head as possible. Over the past few years, I've tried to read and watch YouTube videos on topics that I'm interested in and just learn as much as possible. And then also just to start this YouTube channel as well. Like I've mentioned it several times before, but talking to a camera really does lock a lot of ideas into your brain, and you know, you don't really know if you understand something until you say it to a camera or try explain it to another person. So that's been really helpful, really powerful, and it's helped me develop a lot as kind of an individual. So those are my thoughts on that one. Eric asks, who are some good New Zealand musicians / bands / singers? I was trying to have a think about this one before I filmed the video as well, because I don't listen to a lot of New Zealand music actually. I listen to probably like two main types of music I listen to. So if I'm in the gym lifting like heavy weights, I'm often listening to like rock or metal. And then outside of the gym, I'm like a huge country music fan. So I'm listening to like a lot of American stuff like Luke Combs, Alan Jackson, all sorts of stuff like that. So in terms of New Zealand bands, I don't listen to too many, to tell you the truth. Probably something like 660, which everyone listens to, I think. And actually just in the last week or so I've been on this random throwback to like Zed and Nathan King, so if anyone remembers those days or isn't from New Zealand, maybe go and check that stuff out. So thanks for the question, Eric. Final question here is from Henry. Hi Tom, I don't use them, but what's your opinion on charting, e.g. stochastics, moving averages, MACD, etc.? Yeah, so I mean Phil Town, I think it was in Rule 1, probably spent about the back like third of his book talking about technical stuff like this, and really I've never used it. Like the way I approach it is if something's trading at a large discount to intrinsic value, I'll buy a chunk of it, you know, if I understand the business and like the management and all that sort of stuff. And then if it gets even cheaper again, I'll buy another chunk. And that's kind of the way I approach it. I really just make valuation the key kind of thing to drive my buying decisions at this point. So I don't really use a lot of technicals. In fact, Phil Town actually kind of went back on this himself in his second book, where he was talking about using that averaging down and just buying more if the price goes down type strategy as well. So I really don't use it. I haven't spent much time studying it, to tell you the truth, outside of reading that first Phil Town book, Rule 1. So I don't know, maybe some people are doing well from it. It's just not my style, and I'd rather spend that time researching more companies and doing that sort of stuff than trying to, you know, dig into charts and all that sort of thing. So that is that, and that is all the questions we have for today. So thank you again for all the support to get the channel to 20,000 subscribers. I do hope you enjoyed that video, and I hope you continue to support in the future. It's been a great journey to get to this point. So that's all from me today, and I will see you in the next one. Cheers.